Stephen Nathan, the Chief Executive Officer of 10X Investments, joins us now for a look at whether you should be upgrading your retirement portfolio just like your cell phone. Stephen, I learned a new term a couple of days ago. It's called FOMO, which stands for the fear of missing out. And this is apparently one of the key drivers behind why people actually upgrade their cell phones. Because if David has an iPhone, I must also have an iPhone. Do you think people suffer from FOMO when it comes to their retirement portfolio?
Without a doubt, there's actually been a lot of research done, and we're far more emotional than we are logical. So we all know that when share prices are low, we should be buying, but normally the economic environment and the news flow around the weak markets like the 2008 crisis, everybody actually wants to sell, and we follow our emotions rather than our logic, which tells us we should be buying at low points and selling at high points.
Stephen, it's very simple, isn't it? Because the analogy between retirement products and investment products and the cell phone industry is a pertinent one, because, you know, here we are sitting around saying, well, we should be doing this, we should be doing that. There's one guest here, there's one guest there. But you're not sticking to your knitting, as they say. You're not sticking to the basic fundamentals. You're getting seduced by advertising. Stick to buying low, selling high, and sticking to the things that David Shapiro has made a success of over the years. In other words, you know, good quality companies, dividend yields, etc., and solid companies that provide these things.
Without a doubt, if you look at a retirement saver, you're going to be investing from your first paycheck to your last paycheck, so 40 years. And we did just a quick analysis. If you go back to 1973, you would have retired in 2013. That's 40 years. And there are so many financial events. You had the 73 oil crisis, inflation went through 15% in the US. Then in South Africa we had the 76 Soweto riots. You had, in 84 we had a debt moratorium, we had the Rubicon speech, we had the 1987 crash. The market both locally and globally fell by over 20% in one day. You had, in the 90s, you had the Asian crisis in 97, the Russian crisis in 98, 9/11 in 2001. I mean, I can go on and on and on. And the point is that every time people are looking, well, should I change my portfolio to a changing environment? And had you changed, you probably would have bought high and sold low. But if you held throughout that period as an equity investor, had you invested a rand in the South African equity market, adjusted for inflation, it would have grown 23 times. Had you invested 1 rand in the international equity market in rands, it would have grown 11 times. And had you been scared of the fluctuations of the stock market and all the news flow, had you invested in cash or bonds, your 1 rand would have only doubled over that period.
Steve, your big selling point is costs. You know, the costs associated with investment, and that you offer a very low cost investment product, and which you reckon could beat. And I agree with you. Sipa went and she mentioned FOMO. We've got another one called FICA, which is Ford, Investec, Coronation, and Allan Gray. Do you find that out there in the industry, in the same way as people are emotional, that they're not thinking, they're merely following what's fashionable?
Without a doubt. I mean, the investment landscape is so complex. Even if you're in the industry, we sometimes struggle to find out what these portfolios mean. So what happens is that because you've got so many different choices and there's a strong marketing machine, so all the best performers are being marketed, it creates the impression that every fund's a winner, when in reality it's only 10 or 20% are the winners, and the 80 or 90% that are doing badly no one's talking about. So there you get FOMO again. Well, you know, at the BRI, John told me that his portfolio went up X%. So people are definitely chasing past performance. They're definitely chasing brands, because even if those fund managers you mentioned, some of them have done very poorly over the last 5 years.
You can mention them on air here, you know. Well, it's only going to help us, please, you know.
But as an example, I mean, Allan Gray's got a very good long-term track record. But in that long-term track record, there's been underperformance, and people haven't stayed the course. If you look over the last 5 years, Allan Gray has significantly underperformed. But people still trust that brand because they don't actually know what the numbers mean. And even if you do want to go to one of these fund managers, which portfolio do you buy? Because, for example, Coronation has got, you know, some great portfolios, but not all their portfolios are outperforming all the time. So merely by going there doesn't guarantee that you're going to get the portfolio that has done well.
Steve, there's another line that you were quoted in that I think would have people up in arms, or fund managers up in arms, and you say the secret to investing is that there's no secret at all.
Without a doubt. I did the CFA. The CFA is the professional qualification for investment professionals around the world. And I did that 20 years ago. But what I learned 20 years ago was actually the 1950s and 60s, what's called modern portfolio theory. So the real financial innovations in how to structure portfolios that increase long-term risk-adjusted returns. What does it mean? It means that you're going to get a good long-term return, and risk means that when you have poor periods, you're still going to do okay. And all of that body of knowledge was developed in the 50s and the 60s by people, Harry Markowitz, Eugene Farmer, William Sharpe. Those are people that got the Nobel Prize maybe 40 years after they did it. But there's been not one financial innovation in decades that has improved investors' returns. But there's been lots of innovation that's helped financial services companies sell lots of product.
Steve, let's wrap this up now. We've got a FOMO of FICA here. In other words, a fear of missing out on whatever it was. What was FICA again, David? Just quickly tell us, FICA.
FICA. Ford, Investec, Coronation, Alan Gray.
Okay, so we've got a FOMO of FICA. I've always said throughout my career in financial services and broadcasting that we should have a psychologist, a psychiatrist on the desk, both in trading rooms and also in the rooms where you sit down with those poor victims of yours, all of you people in financial services, and say, this is what we should be doing. Because it's all to do with human beings and all to do with, as you say, Nozipho, the fear of missing out. So get someone to sit you down and say, this is how you should be behaving, never mind the markets, and human behavior will take over from there.
Without a doubt. I mean, I remember the 2008 financial crisis. After the crisis, all the companies were marketing these products where they had you holding a small little nest egg and saying, now's the time to protect your capital. But your investment had halved. It wasn't the time to do that. It was 2 years ago was the time to protect your capital, but equity markets were running and they were telling you to invest in equities because that's how you get the greatest return. So you're exactly right.
Steve, I'm not sure how much time we got. One last question. Do these houses always publish the results after costs, or is it before costs? Because that's an important point.
The retirement fund industry is always before costs. So if you look at these retirement fund surveys, their argument is that everyone pays different fees, so we don't really know what they are. So one of our biggest gripes at 10X is that take any benefit statement, any statement from your company, pension or provident fund, look at it and see the investment fees you're paying. It's not disclosed. So you actually don't know what the true costs are. But if you look at unit trusts, they do take off investment costs, but not in the retirement fund industry.
Steve, thank you so much. That is the FOMO of FICA. A big thank you to Steve, Nathan.